Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. What a month! Over the course of November, global bonds were up 5.1%, the best month since December 2008, while global equities was up 9%, the best month since November 2020. The US dollar also fell 3% last month, aiding the returns of risk appetite. This rally does raise some interesting questions for the months ahead, as usually December rather than November tends to see the most seasonal strength. To discuss this and more, we are joined by Fook Hien, our senior investment strategist in the CIO office. Hello Fook Hien, 9% in equities. What do you think comes next after November's stellar rally?
Yeah, thanks, Zhong. The return of risk appetite has been triggered by rising expectations that major central banks are done with rate hikes and are now looking for confirmation from cooling inflation data to cut rates in 2024. We saw that in the US and Euro area inflation data this week, confirming the global disinflationary trend. We believe that equities, bonds, and the US dollar will need to overcome key technical hurdles in the near term. However, investor positioning is still supportive in our view for further upside for risk assets until the year end. Now, on aggregate, investor positioning in US equities has turned neutral after quantitative model-driven funds drove the rally in November. However, positioning among retail investors and mutual funds remains tepid, as both investor classes did not participate in the rally. This leaves scope for further upside in equities if retail investors join the rally into the year end or if bearish hedge funds capitulate. The balanced mutual funds are more likely to rebalance in December from equities to bonds after November's sharp outperformance of equities. However, investors will need to stay nimble, watching out for any significant economic slowdown in the coming months, especially any sharp deterioration in job markets. We have the US ISM manufacturing PMI data tonight and US job openings and non-farm payrolls data next week, and these are the next key signposts. The markets would need modestly weaker but not sharply deteriorating activity in order to sustain November's stellar rally. Now, also worth pointing out some near-term chart hurdles. The S&P 500 index in the US, it faces strong resistance less than 1% away at around 4607. A break higher could lead to a test of 4637, followed by January 2022's all-time high of 4818.6. The US 10-year bond yields is testing key support in the 4.3 to 4.35% region, and the next support is around 4.05%. The broad USD index, or the DXY, meanwhile, it appears to be recovering from oversold levels, bouncing back from just above the 102.3 support level. The next resistance is just above 104.
So we saw some US data recently and it's quite mixed. What are the implications of that on equities?
Yeah, we recently had the Black Friday sales in the US, and the recent Black Friday consumption figures were strong. And the Q3 2023 US real GDP was revised higher this week. Having said that, the Fed's Beige Book of Economic Activity is showing some signs of softening economic growth with a deteriorating outlook on the 6 to 12-month horizon. The Beige Book also highlighted a slight uptick in consumer delinquencies, with some weakening in the demand for discretionary and durable goods. So this is likely to lead to a continued pullback in inflation and strong but slowing wage growth in the near term. So under such an environment, we think corporate pricing power is likely to be challenged. In our view, this makes sector selection in 2024 even much more important than in 2023. The degree of corporate pricing power differentiates firms' ability to protect profit margins and earnings growth against rising costs. So far, US companies have been resilient in their net profit margins, led by the mega-cap, high-quality growth stocks that hold strong pricing power for their services. In our view, this bodes well for the communication services and technology sectors where we are overweight.
Well, moving on to the German budget crisis, how would that actually impact European assets?
Yeah, we saw the German Constitutional Court's ruling earlier this month. It's requiring the government to move an estimated 14 to 24 billion euros worth of spending from special funds to the regular federal budget, and this has thrown a spanner in the government's fiscal planning. While the total amount is small relative to Germany's economic output, the debt brake rule means that either the government would need to cut spending in other areas to fund energy transition and energy subsidies, or suspend the debt brake for the fifth consecutive year. Broadly, there are two possible scenarios. One, the debt brake remains in place and leads to a reduction in government spending, further hurting economic growth. Or two, the debt brake is suspended, leading to government spending being in line with market expectations. Now, given that the German economy contracted in Q3 this year and is expected to contract again in Q4 this year, we think a reduction in government spending is unlikely to be a palatable solution. Hence, we assign a high likelihood of Chancellor Scholz securing another debt brake suspension. The fact that the German debt-to-GDP ratio has declined over the past 2 years should also help at the margin. So from an investment perspective, we see the risk to German bond yields and the euro to US dollar as asymmetric. Now, in the scenario that the government spending is reduced, downside risks for the economy are likely to rise. This in turn could lead to an earlier than expected rate cut from the ECB, resulting in a decline in German bond yields and the euro to the US dollar. However, in our base case of an eventual spending increase, we foresee limited downside risk to German government yields and the euro to the US dollar. So from a technical perspective, the euro to the dollar is starting to look overbought, and 1.103 is likely to act as a near-term resistance for the pair. We see a high likelihood of a near-term consolidation, with 1.0785 likely to act as an intermediate support. And for euro area equities, any increase in the possibility of an earlier rate cut from the ECB would likely be a supporting factor. A contraction in the German economy and fears of further weakness have already led to significant outflows and low investor positioning in euro area equities. The 12-month forward PE for the region is at a 26% discount to global equities, significantly wider than the historical 13% average discount. So overall, we do see a limited impact from the German budget crisis on euro area equities.
Well, we are out of time here, so let's end it here. But before we do that, some takeaways from today's podcast. One is some consolidation ahead, but positioning is not yet extreme. So we recommend that investors stay invested into year end. And the second takeaway is that the recent US data, while it's a bit mixed, we think that it's generally positive for US tech and communication service sectors. And third, the budget drama in Germany has a bit more impact on euro and less so on stocks and bonds. Thank you so much, Fook Hien, and thank you to our listeners for listening from start to finish. We hope you enjoy the podcast. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.